The foreign exchange market operates as an exercise in pure capitalization, driven by the capture of exchange rate fluctuations between national currencies. Effective analysis begins by stripping away retail trading tools. Lagging indicators like RSI rely on delayed mathematics, presenting historical noise rather than actionable insight. Institutional-grade algorithmic trading requires predictive, objective data inputs. These objective inputs exist in a strict duality: macroeconomic economic forces that dictate global value and microscopic structural footprints left behind as that value is transacted. Reading true price action means observing the raw forces of global liquidity to locate exact entry and exit parameters. Macroeconomic fundamentals establish the absolute directional bias. These national-level catalysts dictate currency strength before any technical analysis is applied to the chart. The primary driver is the Federal Open Market Committee, or FOMC. This branch of the Federal Reserve sets baseline interest rates for the U.S. dollar. Interest rates operate on a mechanical inverse relationship. Higher rates constrict market liquidity, but increase the valuation of the domestic currency. The second major catalyst is NFP, or non-farm payrolls. This measures the total number of paid workers in the United States, excluding the agricultural sector. By tracking job creation in commercial and industrial sectors, NFP acts as a binary indicator for economic health and currency strength. The third catalyst is CPI, the Consumer Price Index. This metric examines the average prices for a basket of consumer goods and services. CPI measures inflation, which dictates domestic spending power and forces central banks to adjust their interest rate policies. These macro catalysts set the board's rules. Trading against them introduces extreme volatility, as these forces override technical execution. Once macroeconomic forces establish the bias, the focus moves to micromechanics, where data is translated into market geometry. The Japanese candlestick serves as a precise geometric record, documenting the open, close, high, and low data points of specific order flow over a set time period. The engulfing candle footprint is characterized by a massive size differential between two sequential candles. This volume proves that aggressive institutional capital is entering the market and overriding established retail price ranges. Precision is also found in morning star and evening star formations, three candle sequences that appear at the edges of a trend. These formations pinpoint geometric trend exhaustion and mark immediate reversal nodes. These footprints serve as visual proof of institutional capital being actively deployed at specific price levels. Subjective chart analysis leads to inconsistent execution. When a trader interprets market structure based on visual bias, the results are rarely repeatable. Establishing a mechanical trading framework requires strict mathematical rules for defining market structure. The two-candle retracement rule provides this rigid standard, allowing for the objective identification of structural pivots. A single opposite-color candle is categorized as market noise. It lacks the sequential volume required to establish a new structural pivot. A valid retracement is triggered only when two consecutive opposite-color candles close lower. This locks in the preceding peak as a confirmed high. This binary logic confirms every high and low on the grid without requiring human interpretation. Enforcing this rule standardizes the decision-making process, transforming a chaotic chart into a mechanical grid where every pivot is defined by data. Mapping the grid requires differentiating macro market movements from micro pullbacks to avoid entering on false signals. External structure is the overarching macro trend established by the two-candle rule on higher timeframes. Internal structure describes the smaller five-wave sequences that operate inside a temporary pullback within the macro trend. These pullbacks identify trend-joining levels, or TJLs, which serve as strategic entry points. A TJL marks the specific execution node where the internal pullback exhausts and realigns with the dominant external trend. A change of character, or CHOCH, signals a failure of the established structural geometry. A true CHOCH occurs when price action explicitly breaks and closes past a confirmed lower high, signaling a definitive momentum shift. Differentiating internal and external structure prevents models from being faked out by temporary noise, reserving capital for verified trend shifts. Locating institutional inefficiencies within the structural grid is the final layer of the framework. Sudden high-volume price moves often leave behind unbalanced pending orders in the market ledger. The visual footprint of this imbalance is the fair value gap, a three-candle formation representing unfulfilled order flow. The gap is valid only when the wicks of the first and third candles do not intersect, proving a void in liquidity exists. This leads to the Interbank Price Delivery Algorithm, or IPDA, which governs how institutional liquidity is delivered. IPDA's systemic mandate is to balance market ledgers and correct these aggressive inefficiencies. IPDA drags price action back into the FVG to execute pending liquidity, satisfying the ledger before the primary trend continues. Fair value gaps function as magnetic algorithmic targets used by institutional players, making them highly predictable zones for execution. Fractal confluence, the tap-and-go model, is the method for executing trades with institutional precision. Step 1 is locating a macro inefficiency, such as an FVG, on a high time frame like the 1-hour chart. Step 2 requires waiting for the price to physically tap this high time frame zone. Step 3 occurs the moment the tap is recorded. Drop down to the lower time frame to observe the granular price action. Wait for a micro change of character or an engulfing footprint to confirm institutional defense of the zone. Tapping a macro level is not an execution trigger on its own. Blind entries at these levels significantly increase risk exposure. Fractal alignment stacks a macro target with a micro-mechanical trigger, isolating high-probability execution nodes. Structural analysis and fractal alignment are secondary to strict risk parameterization. Without defined constraints, the strategy remains incomplete. Total risk must be capped at a maximum of 5% of capital per trade. Account size is irrelevant to the strategy. A $500 account and a $10,000 account operate under the same fixed risk parameters. Using a position calculator, this fixed risk percentage and the structural stop loss are converted into an exact lot size. Algorithmic trading relies on executing a strictly risk-defined mechanical framework where human bias is removed from the final execution.